Global stocks are rising as investors turn more hopeful that the U.S. Federal Reserve may slow down the pace of rate hikes to support economic growth. Markets in Asia are green across the board. U.S. stocks are also set to open higher later in the day when trading begins on Wall Street. That's ahead of the American Central Bank's two-day policy meeting that begins on Tuesday. Most analysts expect a rate hike of 75 basis points, matching what the Fed has done in the last three meetings. Its goal is to tame inflation, currently running in the U.S. at a four-decade high. And while investors want to see the Fed turn the corner, consumer price hikes could still go faster due to geopolitical tensions. Now let's go to Stephen Innes. He's managing partner at SPI Asset Management in Bangkok. Welcome back to the program, Stephen. Now let's start with the Fed. How much more can they continue raising rates at the current pace? When do you see their pivot coming?
Yeah, it's a good question. And I think we're getting close to the end of that rate hike runway. So in other words, I think the rate hike cycle is coming to an end. We may not be there yet, but we're getting close. And I think this is why the markets are a little bit more enamored with trying to price in sort of a slowing of the pace of rate hikes to allow the lagged effects of the recent hikes to set in and perhaps slow the economy down. So perhaps we could see the Fed take their foot off the rate hike pedal today or actually tomorrow. But I don't think it matters whether the Fed hikes 50 or 75 basis points. I think what is very important is what Chair Powell says and how he lays the path out here. I don't think he's going to be so happy if the market starts to price in rate cuts. That's the problem. Market's pricing in rate cuts now. That's why stocks are rallying. So we have to see how this dynamic plays out. I think it's still a bit of a toss-up which way we're going before the weekend. So we'll just have to keep our fingers crossed that equities do continue to move higher.
Now, obviously, the main data point that we're watching is inflation. And one thing that could affect inflation expectations is a story that we've been reporting on all morning is that Ukraine grain deal, uncertainty over whether it can continue and to what effect. So how much can that impact the decision making at the Fed and other central banks and how that affects economies around the world?
Sure, it's interesting. Obviously, it would be a driver of inflation, but it also hits people in the pocket. They just don't have a lot more disposable income if they're paying more for food. So sort of a little bit of a trade-off here. But we have to remember when it comes to food, the biggest component price of food is wages, not necessarily the input of grain. So we have to watch how this market plays out. I think this is more towards a geopolitical risk issue. And I think this is more worrisome from that point that Russia could actually stop just stop exporting grains altogether.
All right. Stephen Innes at SPI Asset Management in Bangkok. Thank you for joining the program.
Thank you.